Welcome back, and joining me now for a look at the equity space is Coertze from Cartesian Capital. Kyle, thanks so much for joining us today. Now let's get things started. We've had traders digest a number of economic data, earnings and monetary policy moves this week, and they've just generally influenced markets action. I want us to start off with that US GDP number coming in at 3.3%, with that economy rather expanding 3.3%, beating economic expectations of 2.2%. Kyle, we're seeing strong numbers from that side. Is it safe to say that the US has defied those recession fears?
Yes, thank you for having me. Whilst it might be a bit early to know if we have achieved a soft landing, the recession has definitely been deferred. But what is notable to me is that in the last 12 recessions that the US has had, the quarter before a recession, GDP growth has averaged about 2.6%. And the quarter of a recession, the GDP declined by 3.5%. So that is a delta of 6.1%. So things can get ugly pretty quickly. We just need to be aware of that. But it is also notable that the last 6 times that the Fed has paused, markets have reached all-time highs, including the recent all-time highs in the S&P 500. But 4 of those events ended in recessions. We still have to see how this one pans out, but hopefully we can achieve the much desired soft landing this time around.
Crossing fingers that's what plays out. Now, monetary policy moves were also under the spotlight this week, with the ECB leaving rates unchanged. Now, this is despite weak economic growth in that region and despite inflation somewhat progressing towards its target. Now, policymakers didn't even give us any sense of, or guidance rather, on when interest rates will start falling. Was this move expected, Kyle?
Yes, well, we know Christine Lagarde at Davos. She mentioned that they might look at cutting rates in the summer. And personally, I was expecting her to dial back some of those remarks, but she actually reiterated them and said that they would look at cutting around mid-year. So markets seem to be pricing in about a 90% chance of the first cut by the ECB in April, with 141 basis points in easing across the year. We'd have to see how that pans out.
Now, looking at the US and Europe, we can see the economies on that front performing quite differently, right? With that being said, it seems like the US economy is kind of digesting that higher interest rate for longer better, or handling it better than Europe. With that being said, do you expect to see the ECB cutting before the Fed?
Well, we know in the ECB that we know specifically in Germany and France, PMI numbers have been horrendous lately. There's a lot of weakness in Europe. America has been strong, obviously. The labor market has performed well. I think it would make sense for the ECB to cut before the US. I think US have the luxury of staying higher for longer while that unemployment rate doesn't pick up.
Now, our local Reserve Bank also kept rates unchanged. Yesterday, I was chatting to a few economists, and we talked about, well, rather, I asked them whether the SOB is taking a wait-and-see approach when it comes to rate cuts, right? And before, when the rate, the hiking cycle started, we saw emerging markets leading that hiking cycle. Whereas now, it seems like there's that wait-and-see approach. Even with Sub-Governor Lesetja Kganyoko yesterday, he wasn't quite positive on when we'll start seeing rate cuts. Do you think there on that front we'll start seeing the Fed cut rate before we can even start thinking of cutting rates?
Yes, Nalatana, to your point, the governor said yesterday that the SOB, they are not time dependent. They will have to look at the data first. And thinking of a cut before the US, I'm not so sure, because we as you know, South Africa imports its inflation. So a continued deterioration in the rand would obviously remain as an upside risk to inflation. I think we might just wait until the Fed cuts before we cut.
All right, let's shift focus to some company news. We are in the thick of earnings season out in the US and Europe. We saw the world's largest luxury goods owner reporting, LVMH reporting strong set of numbers with record sales and profits for 2023. What have you made of those numbers, Kyle?
Well, what's interesting about these numbers is that we saw revenue growth in their 2 key markets, which is Japan being up 20% and China up 15% in the fourth quarter. So the Chinese consumer is clearly indulging in luxury goods as well as travel. So that is surprising to me, given the challenges that we are seeing in China. And the luxury market currently displays varied trends. For example, the British label Burberry has signaled a slowdown in demand through its profit warnings, whereas the Swiss conglomerate Richemont, which counts Coertze as its flagship brand, reported continued sales growth in the past year. It's a mixed bag, I would say, yeah.
It is a mixed bag, but on the other side of the spectrum, we look at luxury goods and you see that sector performing fairly well. On the other side of the spectrum, when you look at other retailers that aren't necessarily catering to the rich, something like Lewis, where we saw cash-strapped consumers continue to rely on credit. According to its trading statement, credit sales jumped over 17%, now accounting for over 65% of its total sales. Kyle, this just shows how the kind of pressure the SA consumer is under, right?
Yeah, well, these companies, they definitely cater to different consumers. We know with high interest rates, the rich have got money invested, they're earning those high rates. While if you look at our local counter, Lewis, I saw the revenue increase by 8.7%. But yesterday we heard Kganyago say that the South African consumer is intolerant of high inflation. But these results don't seem to be reflecting that view at all. Consumers are still buying, but it seems that they're taking on more credit. In the UFO furniture stores, which are cash only, sales declined by 14.5% for the 9 periods to December, while credit sales for Lewis increased. So the consumer is clearly still spending, but I'm not sure we want to own a stock that is this exposed to consumer credit in this current interest rate environment, I would say.
All right, let's get to your stock pick right now. I know you're also choosing a retailer, but a different kind.
Yes, I'm going to hang my hat on Mr. Price. Mr. Price put out a decent trading update yesterday with total sales up 10%. Consumers that are under pressure will perhaps be looking to shop down. We also know that Mr. Price is a cash business. And despite trading at low valuations, we don't think the stock is a value trap. In fact, recent momentum to the upside may just be the impetus that this counter needs going into this year.
Thank you so much for your time and those insights, Kyle. That was Kyle Coertze from Cartesian Capital.